Hello, from LPL Financial. Welcome to The Talking Point. I'm your host, Quincy Krosby.
Good morning, everyone. This is Quincy Krosby. This is The Talking Point. It is Monday morning, May 1st. Welcome to May. It's amazing, actually, that the year is moving so quickly, and the Federal Reserve is due to meet this week, which is probably the big event in the market. Although, that said, we have a host of important earnings reports, especially Apple will be coming in after the Fed's announcement on May 3rd. Apple will be reporting May 4th. It's incredibly important because, as we know, Apple is in so many portfolios. Its weighting in the index is extremely high. And on top of all of that, Big Tech has not disappointed. The only disappointment we saw and heard was with Amazon, but not from the earnings report, but in the guidance in terms of a slowdown in their expectations that they believe will continue for a bit longer in terms of cloud budgeting for their customers. But overall, their earnings report actually initially was rewarded by the market until, again, the guidance was offered during the follow-up call with Amazon leadership. So in any event, this earnings season has been actually pocketed by more upside surprises. And this comes from a broad spectrum of sectors. We saw it in some of the pharmaceuticals. We saw it with certainly in consumer names, consumer staples names, and some of the, again, fast food reports. I just mentioned McDonald's, but the one thing that they all had in common was they raised prices, and consumers were continuing to purchase their goods. That was a positive for the market. In addition, as I said, Big Tech has not disappointed, and we're going to hear from, again, Apple this week. But this week, we also have the Fed meeting, and I want to go over that with everyone. The market is obviously hoping, hope upon hope, that this is the one and done, that the Fed finishes up and also makes it clear that they are finished. Now, certainly, you have many analysts suggesting, and also many Fed members suggesting, that this is what they would prefer, that the Fed should just pause and wait to see how the cumulative effect of the rate hikes are working their way into the economy. You know, the rate hikes and rate cuts, by the way, work with a lag, actually a pretty long lag time. That said, you also have a big bet coming from broad section of hedge funds and portfolio managers betting against the U.S. dollar. Why would that be? Well, the reason above all else is that the Federal Reserve finishes up the rate hikes, right? And the U.S. dollar loses its status vis-a-vis the European Central Bank, which is going to continue raising rates, along with the Bank of England. And those central banks are still in movement to raise rates because they do have inflation. The European Central Bank, by the way, is what we call a rules-based central bank, only one mandate, and that mandate is price stability. And inflation has inched higher there, and they've made it clear that they are going to have to continue moving. Keep in mind, too, that we, the Federal Reserve in the United States, that we saw rate hikes beginning before these other central banks began raising rates in earnest. So, and it's called the interest rate differential. The central bank that is most aggressive against the basket of currencies we trade against, which is, by the way, the developed markets, that currency is the strongest currency. So what the market is betting on, and these bets that they make in the market, is that the U.S. is going to be finished with rate hikes. And as you know, the market is also probability suggesting that there will be rate cuts this year, again, which moves towards a weaker currency. In our case, it is obviously the U.S. dollar. So the question is, does the Fed deliver what the market is expecting? Or do the contrarians come in and say, not so fast? We know that there is a debate going on at the Fed. How do we know that? Because we hear it with Federal Reserve speakers out there publicly. Some are suggesting that, the Fed shouldn't be focused on wages so much, that should not be something that should factor into the Fed's decision. Keep in mind that the Fed has made it clear, at least Jerome Powell has, that when wages keep going up, even though it is the lower wage earners actually enjoying wage hikes for the first time, that you have to come in and take that into account, because all of those services that they work for and companies that they work for that are raising wages will try to pass that along into higher prices. That's how you have inflation. Companies see wages as an input cost, the same way they see, natural gas if it's a manufacturing company or oil. They see it as nothing more than an input cost, and that then gets, hopefully, according to the companies, hopefully along to the end buyer, the consumer or corporation or small business owner buying the goods and services. So the Fed, at least Jerome Powell, has said over and over again, you cannot have a strong labor market, you can't have a strong economy unless you have price stability. So this is going to be interesting because as I speak this morning, I'm looking over statements by a number of the Federal Reserve speakers saying, hey, not so fast. However, the Employment Cost Index, the ECI that the market watches very closely, has climbed higher, suggesting that wages continue to move higher. We do know, by the way, that some major companies are raising wages. We've heard from Walmart that they are raising wages. Home Depot raising wages. Why? Because they want to maintain loyal workers, and they feel that overall maintaining workers that stay with higher wages and some cases higher benefits, that they will stay and be prepared when the economy begins to turn the corner and climb higher. So this is something that's going on. It's a debate within the Fed, and there are those of the Fed who are saying, you know what, now's the time to pause, now's the time to watch and wait and see how the economy reacts, versus those who are saying, no, if we do that, if we pause, we run the risk of a 1970s style underpinning where you allow stagflation to creep in, where, you let inflation move higher, but the economy doesn't do well. So there is this tug of war even within the Fed, and it's going to be interesting to see, again, how they handle what is expected this week, May 3rd, with the rate hike. How do they package it? What does the Chairman Powell say at the press conferences? What does the statement say? Is it a firm rate hike, or is it one that opens it up for a pause? Obviously, we don't know, and most likely they don't know yet. One thing we do know, and that is that they will receive the Fed's survey of senior loan officers before it comes out to the public. The Fed has its own survey, and in addition to the survey announcement that they will receive before the announcement of their rate hike, they are in touch with all of the banks to find out if lending has been subdued. Are the standards so high that it's harder to get a loan? If you're a small business owner, if you're a consumer, saying you're a consumer wanting to buy a vehicle and it just becomes too difficult, they are going to have a good sense of it up until this week, of course. Now, having First Republic off of the headlines finally certainly helps the Fed, does it not? They're not going to be raising rates amid the concerns about a major failure. This deal with J.P. Morgan, assuming most of the assets from First Republic, goes down in the history books as the second largest bank failure in the U.S. Washington Mutual was the first. So that is now easing in terms of the headlines, helping the Fed raise rates. This meeting will be very strange if they don't raise rates, because the Fed funds futures market has it nearly 90% that they are going to raise rates at this meeting. Nonetheless, the market is prepared for what they have to say in the statement, and also the press conference, which is going to be particularly important for the market. In addition to that, this week we have the payroll report on Friday. And obviously this is important because all of the talk about a recession, the question for the market really is, all right, let's assume we do have a recession. What kind of recession will it be? Will it be a deep one, a shallow one? And the reason the payroll numbers are so important, the labor market is so important, is that historically, absent some shock to the country, the typical recession stems from heavy layoffs, where the unemployment rate rises and rises substantially. What that does, obviously, is it hurts personal income, which then pushes consumer spending down. Consumer spending has been holding up, albeit credit card usage is up too, but overall the consumer still has been fairly resilient. We saw that in the report that came out for the GDP report. But at the same time, inflation remains sticky. Now, to be sure, the part of the inflation scenario having to do with the rent equivalent in the Consumer Price Index, the CPI, that is going to ease. We know that from all of the industry reports, that the new leases are much less heavy, rent heavy, than they were, a year ago. That is going to have a material effect on the Consumer Price Index, along with the PCE, the Personal Consumption Expenditures Index, which is the Fed's, preferred measure of inflation. But nonetheless, inflation is coming down, but not as fast as the Fed would like or that the market would like. And it's going to be interesting to see how the Fed handles this at the meeting. And as I said, couple this with the employment cost index climbing higher than expectations. Those at the Fed, including Jerome Powell, are going to have a debate with those at the Fed who say, hey, not so fast, stop focusing so much on wages. Interesting scenario, to be sure. But that said, the market itself, now let's put this in a construct, if you will, has had enough defensive stocks moving higher on rallies. That would be consumer staples. We've even seen utilities, and we've seen, the pharmaceuticals, the drugs move higher. Though, at the same time, on other days, we see that traditional cyclically oriented rally. That's important because, again, the more we see the defensives climbing higher, the more it is the market's way of saying, we're getting ready for a slowdown. We're getting ready for a recession. So what we want to see after the Fed meeting is, how does the market react? How does the bond market react to the Fed's decision? Keep your eye on the 2-year. Obviously, that is the monitor of the Fed policy. That will react. If the 2-year yield goes down, it's telling you that measure means that measure sees the Fed finished or almost finishing. Now, the 10-year, and this is important, if the 10-year yield continues to go lower, what it really does indicate is that the market sees that growth is slowing. And here's where it gets, I think, particularly interesting. If the Fed does not make it clear that this rate hike, which we're expecting, by the way, is not a one and done, if there's kind of vagueness in their packaging of it, you may see the 10-year yield come down more than expectations, because that would be the market saying, oh, the Fed, it looks as if it wants to cut rates again, which then for the market could interpret it as really slowing growth, or perhaps pushing us into that recession that everyone is talking about. So there's a lot for the market to digest, but at the same time this week, we are also going to have another round of the producer price reports. And I can't stress enough how important they are in telling us what is going on at the most granular level in the economy. So we are going to have the manufacturing report, and we are going to have the service sector report this week from the Institute for Supply Management, that's ISM, and these are from the ones that actually at the ground level know what's going on. And remember, please remember this, 50 is the line of demarcation. Everything above it is expansion, everything below it is contraction. And we need to see where it's headed. I also want to point out that the Philadelphia Fed manufacturing report was it was negative. It was in contraction territory. But the Philadelphia Fed general report, it's a broader report of the economy, also was negative. In terms of consumer expectations, I do want to report something that the Fed does watch, and that is that consumers, while they're concern over the present actually is not particularly concerning, but looking ahead, and this is important, in terms of inflationary expectations, that has climbed higher. The Fed does not want to see that, because the more consumer expectations regarding inflation climb higher, the more it becomes entrenched. And that's the last thing the Fed wants to fight, is that the consumers believe, inflation is crawling higher. That's not a good thing. I want to add, too, here, that when gasoline prices keep inching higher, in where I live, they've started to level off, but they had been inching higher almost every day. It really does affect consumers' expectations of inflation. It's something that you see every day. It's something that you internalize. Even if you drive a hybrid vehicle, even if you try an electric vehicle, you will see those changes in the gasoline prices at the pump. Also, I do want to add here that diesel prices have been coming down. That happens to be, for many, a leading indicator in terms of trucking. That the more diesel prices come down, the more it indicates lack of need for diesel, and that is the trucks, and therefore the thinking is that goods being moved around the country will slow. We'll see how that pans out, but it tends to be an important, at least in terms of durables, an important number for many who follow what the trucking sector is indicating. That also is, I think, extremely interesting, because durable goods did go up, right, but not core. And core durable goods, this was from last week, is what companies spend. It's their capital expenditures. That came down, but overall the durable goods in general moved higher. So we're at a crossroads, that's all that I can say, and the market is trying to discern which direction should we go. This week, with factory orders coming in, with the ADP private sector report in terms of payrolls coming in on Wednesday, and the payroll report on Friday, and also the ISM numbers, not to mention the Fed, not to mention more earnings. And again, Apple, after the close on May 4th. This is all going to be taken in by the markets, by the fixed income market, by the currency markets, and obviously by the equity markets. Have a very good week. We'll be back next week. Thank you so much for listening.
This material was prepared by LPL Financial. It's for general information only and is not intended to provide specific advice or recommendations for any individual. There is no assurance that the views or strategies discussed are suitable for all investors or will yield positive outcomes. Investing involves risks, including possible loss of principal. Any economic forecast set forth in the podcast may not develop as predicted and are subject to change. References to markets, asset classes, and sectors are generally regarding the corresponding market index. All indexes are unmanaged and cannot be invested into directly. Index performance is not indicative of the performance of any investment and do not reflect fees, expenses, or sales charges. All performance reference is historical and is no guarantee of future results. All information referenced in the podcast is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy. Securities and advisory services offered through LPL Financial, a registered investment advisor and broker-dealer, member FINRA and SIPC. Insurance products are offered through LPL or its licensed affiliates. To the extent you are receiving investment advice from a separately registered independent investment advisor that is not an LPL affiliate, please note LPL makes no representation with respect to such entity. If your financial professional is located at a bank or credit union, please note that the bank or credit union is not registered as a broker-dealer or investment advisor. Registered representatives of LPL may also be employees of the bank or credit union. These products and services are being offered through LPL or its affiliates, which are separate entities from and not affiliates of the bank or credit union. Securities and insurance offered through LPL or its affiliates are not insured by the FDIC or NCUA or any other government agency, not bank or credit union guaranteed, not bank or credit union deposits or obligations, and may lose value.